All right, we are
Then the
back.
doctor said, "Oh, okay."
Yes, sorry, let's get right here. Paul has begun. The press conference has begun. To start off with a good afternoon. Let's bring that in. Market's pushing higher here. There he is.
Thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level.
What?
Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, here's a Q&A.
All right. A little selling right there at the end of that.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
There you go.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity?
3 times AI for Polymarket. Let's
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
New lows, gold, silver, starting to roll over.
Thank you, Mr. Chairman, for taking our questions here.
And you're selling off also.
I guess
You had
68.50.
previously described
SPX.
rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
Most I've heard him
Just,
talk of
one more
a
question
single
on
question.
this sense. I mean, you talk about in a very
Yeah.
positive way,
Tough
just the
one.
Wordy.
complicated
Yep.
nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Damn, Powell.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy
here we
risks
go.
as genuinely two-sided from here?
I'm watching tenure.
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Yes, pushing here, Jack.
Claire Jones,
It is
Financial
pushing, I think.
Times.
So
A
this
lot of
question,
people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation,
New highs on the NASDAQ.
It's coming a touch lower.
Sounds like bad news, good
the
news.
Evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things.
0.5% away from all-time highs, yes.
This was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. it's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, you know, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That, you know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, you know, it takes, there's the announcement of a tariff, and then there's, you know, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, you know, it may take, you know, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. You know, we haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, you know, that's one part of it is inflation compensation break-evens. And, you know, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there.
All right, real quick
why are rates
recap.
going up? It has to be
Real quick recap here. We got Jerome Powell press conference going on here. FOMC, Jack, quick thoughts. ES pushing higher, about 50 points from all-time highs in the ES. But,
Yeah, we got one tick below 6,900 in the ES. We're about half a point away from all-time highs in the SPX. I think they liked how he answered the question about possible rate hikes next year. Overall, still be on your toes. Seems a little exuberant right now for what he's saying. This is pretty much what we expected, but he's been answering the questions, I guess, devishly.
I would say so. Hogue, anything in gold turnaround there? But right now, I'm pretty much in range, Hogue.
Yeah, gold is pretty much just kind of established a little bit of a wider range here, but it has been an absolute buzzsaw. Anybody who's been trading it, be careful. It has been very, very vicious and probably like sticking your hand in a wood chipper at times. Be just watch and see what happens. There's another good push to the upside.
Good push. Yep.
As far as Powell,
yeah, go ahead.
He's kind of pushing the tariff inflation kind of a little bit down the road, if you ask me. But like he said, we don't really know how it's going to affect things in the future. And I like what he said. It doesn't. Maybe it's a couple of basis points, and it probably won't be that big a deal. So it's one of the things that stuck out to me.
Sounds good. JD making new highs in the NQ.
NQ sitting right underneath new highs right now. I thought he kind of threw some cold water on the prospect of rate hikes next year. He did quote him saying rate hikes is not the base case for next year. The more popular play is for a hold or potential cuts next year. So I did find that interesting. The dissenters really kind of turned things around a little bit, even though one dissenter was looking for a 50 basis point cut today. But yeah, we are approaching more new highs right now in the NASDAQ.
All right, about 30 more minutes left here in the Q&A. Then we'll get Power Hour cooking here. Get back to Jerome Powell press conference
you're okay
here.
with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is.
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low twos, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, you know, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. You know, the best we can do is to have a, you know, price stability and a strong labor market. What we saw, for example, what we saw at the end of the, you know, the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, you know, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have you know, full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, you know, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. You know, housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, you know, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and you know, really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, you know, a secular housing shortage, a structural housing shortage.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, you know, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? You know, so that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that you know, the labor market gets tight or the economy gets tight, and you see, you know, just traditional inflation. I don't see that as particularly likely. But so I think, you know, again, you know, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to
inflation nearly
make an
60
assessment,
times so
and
far.
this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had, you know, 5-6 years of 2% productivity growth. this is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it
You gotta
more
get
productive.
NVIDIA green.
It
Still
may
down a buck.
make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we
We
are
finished
seeing
by
we're
2:30.
definitely seeing higher productivity. I
Yeah.
think it's a little quick to be saying it's generative
Gold cooking here.
but
Yield's coming down the
I don't know.
10-year.
The pandemic
Mm-hmm.
may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Trump hosting a roundtable right now, talking AI for right now.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my
500
efforts are
yes,
to get to
900.
that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Yeah.
And I'm focused on my remaining time as chair.
Ooh, it's the other
got
side of the
anything more than
pillow.
that to tell you.
Uh-huh. Damn, I thought we had him.
Mark, for the last question.
Last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
What an exciting final question.
Don't know.
I know, right?
I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
There you go. Wow. What a last question indeed. All right. Again, the Q&A has concluded. We're going to do a little line shift here, but before we bring in Dolby, I want to get Hogue, thoughts on what we saw in the markets and gold, S&P's big turnaround on the highs right now.
Yeah, so gold has continued to push to the upside. Equities are all pushing to the upside, even crude oil pushing to the upside. I thought that Chairman Powell spoke very well. I thought he answered the questions, as Jack said, as cool as a cucumber. And I thought it was very nice of somebody to actually ask him what he wants his legacy to be. And I like his legacy. So it was
JD.
a good day.
Yeah. Good stuff today, Hogue. All right, JD, quick thoughts before you get out of here. Well done today, but markets looking like they're up around the highs in the NQ, though. What do you think, JD?
Yeah, Hogue made a great call with last week's high being a nice extreme for these markets. We kissed it in the NQ. 25,868 was last week's high in the NASDAQ. Just printed a high of 25,870.75. Just hit it. And peeling off of it right now. I agree. Cool as a cucumber for Powell. I like what he had to say about tariff inflation. Once that subsides a little bit, we'll be closer to that mandate of 2%, which is what he's looking for his legacy to be. He wants to go out on a good note. He wants a strong economy with low inflation. So best of luck to him on that.
All right. Fantastic.
They say he's staying until May. They say he's still staying until May, but a lot of people are saying that El Presidente wants to expedite that process and throw someone new in there as soon as possible. But what are the poly market odds on that? I'll have to check that out.
Wolf of Wall Street. I'm not going anywhere. All right. JD, Hogue, well done. Appreciate it. I'll get more thoughts. Marcus got to digest this. We'll see you, fellas, later. See you tomorrow. Let's bring in Dolby Time. Then we get Jack's thoughts. What's up, Dolby Time? It is now officially
What is up?
You're on TopstepTV. Dolby coming in hot. Like my microphone. Dolby Time. Let's go. We'll get Jack's take on just maybe a quick digestion of what we saw, what we heard in the markets from Powell, and then let's see if we can chop this market up in the last 35 minutes of Power Hour. Go ahead, Jack. Your thoughts.
Yeah, I'll go with Hogue said there. Look at my screen right now. If you're bold, man, it looks like for now at least we turned around exactly at 6,900 in the SPX. I don't think that's coincidental. We were pushing pretty hard. I think Powell did a very good job of explaining everything because just all the news itself, I wouldn't think would be this excessively bullish, especially the part about two dissenters voting for no hike, right? As we're going forward, it was one for more rate cuts for 50 basis points and two for none. That's why I generally don't trade outrights during this, because if you think about it, could you have made money if I gave you that report before? I don't know.
I wouldn't know which way the market is going to go, to be honest with you. No.
If anything, I think there's some relief from the fact that Powell didn't say anything that was, ruining Christmas. So it really, you see the VIX dropped quite a bit. That will often happen during these things, but we're down trading 15 handle, 1570 right now. And had a lot of people obviously puking those expensive puts. And so we rise, but it'll be curious to see if we can get much above that 6,900 in this last half hour here.
Love it. All right, good stuff. Dolby Time. We're also the thing we're not seeing is at the conclusion of the Q&A, we're not seeing the market turn around on us. We're still holding around the highs here in the NQ, 25,853. Dolby Time. You ready to rock?
We are.
Let's do this.
This is awesome. The ranges have just been absolutely incredible today. Hogue had that weekly high around 25,000. I think like 870 or so. I think it was 868 to be exact. It's also the daily range high, and the daily range low was those 580s. So we've been perfectly stuck within this range. Really big question is, are we going to break out of the daily range today? And if we don't, are we going to reject all the way back down again? I think there is a lot of opportunity for a very good trade at these levels here. It just depends what direction we want to take it, because technically the shorts are cheap. We haven't been above these 800s or 900s in a very long time. So do we stop run there and rip back down again? Or do we try to take a momentum trade up and through? Kind of curious to see what chat is interested in here, or even Jack. I mean, are we trying to play a breakout or a sell-off and just get back to the average here?
I don't exactly know at the moment. I mean, trading this definitely is a little bit gunslinger. We could still, I would say that there'll probably be a rock fight at about where the highs are right now. So I guess you could do a cheap short, but with this much momentum to the upside, Powell's done talking. Also, as we mentioned, the 10-year's down to 4.14. So it's pretty big. It was trading 4.21 overnight. We're still elevated over the last few days, or pretty much the whole month of September. But I don't know. I mean, like, you're welcome to try for ranges. It's just that we could still, as the big money comes in towards the end, after that, we could still have some pretty substantial movement here.
Oh, yeah.
All right, you got the countdown clock, lower right-hand corner, 31 minutes till the closing bell. Let's take a look at some of these other prices. ES trading 69.01, session high, 69.06. Maybe that was more of a relief rally, more than anything. Dow about 300 points from all-time highs. Yes, you heard that right.
Wow.
It's trading 48,175. We got gold. Gold absolutely cooking today. We saw about a $40 rally, give or take, in gold during the Powell press conference. Now trading 42.61. Let's go keep an eye on the 10-year. 10-year price is still pushing higher here. Should we do above below, Jack? Let's do above below for the ES, if you'd be so kind. We'll do it for the ES. Jack's really good at this. Last trade 68.99. What is above below? Those that are tuning in, I'm going to ask Jack what he thinks the price will be. The close in about 30 minutes of the ES. We're going to put it to a poll, and you all are going to vote. Will be above or below said price. Jack, what say you?
This is going to be an unusual one because I don't actually like the long trade, but if I have to guess where it's going to close, I am going to say 69.12.
Higher, Jack. I love it. All right,
well,
above below.
Just a caveat there. The reason I picked that is because
that's the number.
I think it's unlikely to go above there. Below here, I don't have too much to lean on. Like, I would just be picking some arbitrary thing below, which I don't like to do.
Bottom of the hour is coming and gone. I like it. Look at the tilt 50-50. What happened in the old MBT during that?
And then it gave back some of it, but it had a pretty good spike up to nearly 95,000, trading 94,000 about right now.
Hal did a good job there. Hal did a good job.
That was solid.
He even admitted it. He got
short and
so
sweet.
worried. He's like, man, this shit's hard, man. We don't know half the time. This data stinks. This data's stale. We're kind of winging it too. We're trying to thread the needle here. I thought he did a pretty decent job, all things considered. All right, poll is up. I will say above also. I'll say above. Let's trade 69.06.
Wow. Below is
10 years
below.
You said
did.
Well,
Okay.
guys, we're talking about 22 points, or sorry, it's 12 points above here. So you're taking the points with that.
You're taking, well, yeah, you're in the money. I'm watching this 10-year continue to grind higher here. As that happens, the yields go lower. MBT trade 93,890. Dobie, what do you like up here in the NQ? I know you like those 8
so good. I mean, kind of licking my chops here on both sides of this thing. It just depends on what side you want to take it. But we have a really nice setup. I mean, you have the even 1 minute consolidation at the daily range high. So it's relatively easy to define risk. Just a question of what side do you want to play it.
Hard a lot in the bid here in the NQ. The president has chimed in on today's FOMC decision. Quote, the Fed interest rate cut could have been doubled. Rate cut was a small number that could have been more. We should be able to do more than 3 or 4% GDP. The market should continue to go up with great results. I don't see why we can't. Don't see why we can't have 20-25% GDP growth.
Okay.
What? 20. Yeah. Heads up. Market should continue to go up with great results. There you go. There you go. There you go. There you go.
There it is. Is that the old president saying buy it, Trey?
Boss, seriously, I think boss just said buy it.
Well,
I can tell you, if we have 25% GDP growth, we're not going to have those low interest rates. Let's just put it that way.
Look at those low rates.
Yeah.
Look at president coming out right now. Don't see why we can't have 25% GDP growth, but this will caught my eye. We saw this back in April. The market should continue to go up with great results.
Only way we're getting 25% GDP growth is if we get obliterated by a comet and then start from a very low number. But I appreciate the optimism.
We're gonna get some bids in. 40s, 30s, and 20s. It's gonna be 3 micros.
Okay.
On a pullback.
Might have to go
see if we can get it.
Might have to go to market. Yeah.
I think we might have to. Maybe we can get a little
Boston
rejection off these 868s.
Market should continue to go up. As dumb as that, for reason taking a trade.
What any size or delta? Anything like that?
What is the delta
that we can cue in on?
Again, to see if we have anything
Nothing
more coming from
on the dome.
You can have tremendous growth without inflation.
Debatable.
Promising. Well, boss said buy it. 10-year, pull back a little bit.
Oh, we do have Oracle earnings too after the bell.
We do have Oracle after the bell.
Right. CEO one time was the richest man on earth. After his stock was up like 40%.
Literally one time.
Absolute rocket ship. Absolute rocket ship. Again, tune into at the buzzer coverage of that as well. As a recap of the FOMC decision we had here today on TopstepTV. Delta NQ minus 1,000, ES plus 9,200. 14 minutes till MOC.
That's a second day in a row we've seen that something like that. Yes, with a positive delta, NQ with a negative delta. We got 840s, 830s, and 820s in. Let's see if we can run these 30s and then bid back up again. This range is holding up fairly nicely up here.
We are holding right on the highs.
Yeah.
Both ES and the
so if we just pull back a little bit. We haven't really tested those 900s at all. I mean, I think that'd be well within target today.
Man, I selected those 6912s for a reason. I think there's just going to be a ton of resistance there. I would be knock me over with a feather if we bust through those.
With a poll is, we got some early returns. We can close the poll. 57% are saying below.
Okay,
So
chat is
saying
bearish.
12. That's bearish.
Chat is bearish.
Okay.
We're gonna see. Ooh, okay. See if we
below.
can get filled here.
What are we working again? Dolby time?
840s, 830s, 820s. So we're kind of starting this in the middle of this range, and then seeing if we can get a little range extension to the downside. We are making higher lows pretty consistently. So it's like one of those things where it's like, how do you don't want to miss the move, right? But at the same time, you don't want to be so stingy that you don't get involved. And so as long as we're making higher highs, which we have been, I think it's okay being a little bit more aggressive here.
I would agree. There is definitely opportunity to be had here in the last 23 minutes of the session. 13 minutes till MOC, market on close. Keep an eye on that 10-year. Trading around the highs there.
Gringo, I do not think we are grasping for a trade. This is a really important levels here.
There we go.
Long one.
Wow, Dolby, turn the audio on.
So what kind of targets would we like here?
12. Oh, there. 26,000?
I mean, yeah, why not? I mean, if we get above this daily range, like what would be like the measured move? Like it would be pretty big. Hold on.
10 years pushing higher here. Yes, about to catch a bid.
We got perfect on that one.
No, so Dolby. Stay locked in. Last trade 25,857. Session highs 25,870 ES. 69.06 half.
I mean,
Push
measured
higher.
move gets you to 26,200. I mean, that's not happening in the next 20 minutes, but maybe we get half of the old range. That'd be 126, 130s. That's way up there too.
See if we get to the 870s. Get to the 870s.
Yeah, then we'll go from there. If we get over 870s, we can start managing it from below. But so far, so good. Long 1 micro, NQ 25,840.
Right.
Let's see how this goes.
Working what, 35s beneath that?
30s and 20s. So just the bottom, kind of the bottom of this 15-minute range. We're expecting it to hold. Like the 5-minute range looks just absolutely incredible. Such a good looking range.
Great looking range.
What's up,
It
Billy?
is.
And now it's stalling out up here.
Interesting on this
10
move,
minutes.
we still got Meta, Microsoft, Nvidia all in the red. Leader of the Mag 7, Amazon up nearly 2%. Oracle's up a little over 1% going to their earnings.
Oh, yeah. Okay.
Oh, Carvana's up another 3.5%.
Nice.
Is
69.04. Last trade ES 69.05. Now NQ trading 25,850. This is the moment of truth right here. 9 minutes to MOC.
Lower highs, higher lows.
10-year trying to catch a bid.
Jabs. The 5-minute range in the NASDAQ currently is incredible. You have basically a bunch of candlesticks all smashed together with relatively equal highs and equal lows. And it's 1, 2, 3, 4, 5, about 6 candlesticks all stuck within the same range. So you're just kind of looking to take advantage of the extremes of that range. So ideally get long the bottom, short the top. If you're a momentum trader, you're looking for longs above, shorts below.
Coming back to the bottom end of this range. Still holding bid in the NQ 25,842. Yes, pulling back
Tilt
just
is
a bit.
negative. Yes, tilt 65% short. NASDAQ 63% short.
telling you, I don't see us breaking that.
We'll see. Don't know. Don't know until you bet. That's what they say.
Hold here. 840 continues to hold. Continues to hold. Some profit taking.
Yeah. I mean, part of this trade too is that Trump was very
He
bullish.
just said buy it. Come on.
That's kind of part of the trade idea too.
I think I saw the quote. 1 second, because this is a great one. Trump, if the market goes up, we should encourage it to go up more.
I like that. I agree. Especially like right now.
I agree.
Right now.
What's the scariest trade? Probably longs. Shorts?
Really?
Longs are pretty scary. Well, yeah, I mean, the market has to push these 870s or else it's come failed moves, come fast moves. So these longs really have to have some conviction here to get this over this range. We've been stuck in it for days.
I mean, when Powell wraps up the Q&A, often in the past, we've seen a bit of a reversal, turnaround in whatever way the market. It did not happen.
The opposite way.
Right.
The classic is the spike up on the release. Powell talks, big spike down, and when he's done, we rally.
Didn't get that this time. What's going on the Dow? Mr. Dow. Looking for anything. Or
RTY has been incredible. Just some of the best range trading available in the RTY. So clean.
Gold, $6 off the highs there. Trading 42.62.
What's Bitcoin doing? Bitcoin looks good.
In the
Go
chat,
back
we're
to
saying
that
we're
little
shorting.
spread
We're shorting, homie. Okay.
You're not
Okay.
short.
The chat, they're saying short.
Well, you'd be with the tilt then, if that's the case.
Oh, 6 minutes till MOC market on close. Also, we'll get you those hashtag power hour, hashtag fast market submissions. Oh, guess we're ready. Give it a minute, James. 5:45 after. Or the market just trade sideways in the close. Power hours.
Bring in Dr. Volatility to get this thing going.
That's true. Okay. Dr. All right, James. Yeah, come on in. Let's do it. We asked you in fast markets. Hit us up at TopstepTV on the X. Let's see some cool submissions. Bring that in. We got 5 minutes till MOC. Dr. Volatility.
Let's hit it. Like Andre said, this morning we asked you to take to the X and share your either hashtag fast markets or hashtag power hour submissions. And here's what you brought. From Too Fast Nate, nice base hit with 1 trade today and a half pass eval. I see a lot of green on that trading calendar, so keep it up, Too Fast Nate. Hopefully we'll see you sitting right here on Topstep TV one day. Congrats. Good stuff. From Kid Icarus Trading. Yo, huge goal achieved for me. Finally getting called up to live on Topstep. I've been super consistent and worked so hard for 4 years trading. Getting this little bit of recognition means so much. Thank you. But you know what, Kid Icarus? It was you who put in the time, the work, the screen time, all of it. You deserve this. Congrats on the live call up. We wish you well in the live markets. Hopefully we'll see your name on the leaderboards in the coming weeks. Next up, we have Andre. Check this one out. This is a cool ass trader space from Enoch. Another 10K month in the making. 1, 2, 3, 4, 5 monitors.
Ooh.
10K setup. I think that's
4.
Kind of hard to tell. Is that Topstep TV in the bottom
Where
left?
is
It should be. If
TV?
it's not, yeah. This is what you
Very
guys don't know.
cool.
We asked for these, and then we looked for Topstep TV. So, and finally, our last power hour submission. This one I included because it stays real. We share a lot of wins, but wins aren't the only thing that happens in trading. So from Harmon, the winning streak finally came to an end. Hit the 4,500 daily loss limit today on my Topstep live account. What happened? I deviated from the trading plan for the first time, and the market collected its due. Reset, refocus, back to execution tomorrow. Harmon, you have the right idea. You have the right mindset. You made it once before. You can do it again. If you need help, Coach Dakota has been through it all. Tune into slow markets. Talk to Dakota. He too went back to the trading combine and came back stronger at his live account. Those are your hashtag fast markets, hashtag power hour submissions for the day. I'm giving this 4 out of 5.
Agree.
Someday I'll be
pretty good,
snappy enough to come up with a fun little bit. But 4 out of 5 for you guys. That's what we got. Back to you guys for MOC for the end of the day.
Hang in there. It happens. Hang in there.
Shout out to Harmon for sharing that. I think that's a great message. Is that no matter where you are on this journey, you're always kind of to some degree in the same spot, which is you always have to follow your plan, no matter what. Doesn't matter how successful you were 5 days ago. All it takes is one day, and not disciplined, it'll blow up your account. It will be true forever, and no matter how big your account size is.
Facts. 3 minutes till MOC.
Lose 150 million trading wheat.
Yep.
I love you,
Market
Jay.
is big enough to take all your money.
Indeed. Wow. Holding pattern.
Still in this
take a look.
range.
Yep. 6903, 6904 is in the ES. Take a look at the NASDAQ trading 25,839. 839 last trade there. MBT. Dow trading 48,193. Wow, they just kept it in a range. Well done, market.
Wonder how those option sellers are doing.
Yeah, Jack. How would have that trade?
They did
played
good
out?
off the. That's why I put the percent right here. If you bought
Mhm.
the straddle, you would have eventually won, but it would have been pretty miserable. That 0.62, I anchored it to the bottom at 1 o'clock when he started talking. So right now, the straddle is this much in the green, but I'm marking this because I can see this is a place it could go. But if you were an options seller, there's plenty of opportunity to make money here when we were just thrashing around this area, especially with the VIX crush.
Where's the VIX?
But wouldn't it be funny if we ended at 68.88? Right now, the VIX is at 1569. Nice.
All right. About 50 after the hour, 10 minutes before the closing bell, we'll get that market on close. Imbalances there. Expect
Can't wait.
volatility. Yeah.
Should be a big one. Should be a big one.
Market is
it's chilling.
It really is 6,900 last trade in the ES. We're under the 5-minute range. NASDAQ trading
30s. Okay, long 2.
40s and 30s. Okay.
Yep, got now we're averaged into 835s. Got one more at 820s. See if we can get to MOC. President was quite bullish.
I would say
follows through.
Come on, it doesn't listen to this.
If he's bearish, we're getting cut in half.
Oh my gosh. Yeah, you know what? He should reverse psychology this thing. Hey, come on, hello.
Take that, market. Never saw that one coming.
All right, MOC coming at you in seconds here.
Yep.
See what we got.
So this will be it here. We'll try to get one off at the higher range if this pops. So about 865s.
All right. 5 seconds. And mixed bags. Mixed bags. Buy side NASDAQ 400 mil. Sell side 500 mil ES. 400 mil sell side. Again, buy side NASDAQ, sell side ES, and the Dow.
Okay. Cool.
Those numbers can and will change.
We're gonna pull our third bid. So we're just gonna roll with these two.
Just showed heavy sell side ES. ES just went 1.4 billion sell side.
Okay.
Why didn't anything change?
Oh yeah, I mean we've seen massive switches. We'll move our stop to 820. Total risk will be $60.
Okay.
With the potential to do, 865 for 2 to 1.
All right, paring back
see if we can get up there.
Okay.
This Dorito's holding pretty good.
Yeah, why didn't it? So 800 mil sell side in ES.
Okay.
Holding 400 mil buy side NQ. Whichever way it goes, it's gonna go. And those numbers can and will change.
See if this range holds.
Yes, looking lower. Yes, looking like it wants to.
It's looking a little squirrely. Looking a little bit squirrely.
We'll go.
Uh-oh.
See, it's just it.
Yep. Well,
is it gonna push?
Not stopped yet. That was a close one.
This is the bottom of the range in the ES.
Yes, it is.
Is it?
We could.
Yeah, we almost got tagged.
Side pulling back. Sell side pulling back. Still 7. I'm sorry. Nasdaq's buy side growing 500 million.
Okay.
Still holding sell side.
I think we're toast. We're toast.
Really?
Damn. Let's see if we end up being liquidity. We got tagged at 819 half.
I'll keep an eye on these numbers. Okay. Sell side. Well, watching the ES right now. Still holding sell side. Sell side. Still holding sell side. Where are they going to take this thing?
Where are they?
Nasdaq still holding buy side. 400 mil buy side.
Really?
Yeah, Nasdaq looks like it.
Feels like it wants 800s.
Yeah, this might be going. This might be it right here.
Maybe bounce off 800s. I don't think so, though. And that would have been a nice
Still
short at
holding,
868.
And what do we got here?
Well,
Interesting.
it's going to be interesting tomorrow.
Can't make up its mind.
No, it really cannot. I'm still very curious to see how we end up treating these 868 level. That's one of Hoag's levels, daily range high as well, weekly range high. Is that going to keep a ceiling on things into like basically this week? If that is the case, there might be some good opportunities to keep on taking shorts off the 868s if it's going to provide 30 to 50 points. Buy side growing. Okay.
Buy side growing on Q. ES still.
I think it matters. They got some thickness in the offers.
Oh yeah, we do. So I was thinking. The moment of truth is.
I mean, Dre, do we go back to the well off this buy side?
Doesn't make up his damn mind.
Yeah, I don't know if it's worth it, right?
No,
it doesn't feel like
no, most certainly not.
It's going heavy sell side. Sell side.
Is it? All right,
here.
forget it.
Yeah.
Forget it.
Sell side growing in the ES. 1.3 billion sell side. NQ still holding buy side for her mill.
It is.
What a chop.
Yeah.
Cameras.
Really good range trading opportunities, even in this choppy mess here. But tomorrow's going to be so interesting.
Buy side growing NQ. Buy side growing NQ.
It's growing, Dre?
Buy side growing NQ.
Wow.
I don't think you can just like look at we're just a few minutes out from like the FOMC. You can't look at the MOC number and like those are already internalized. So like, people knew that number before us.
Mm-hmm.
And 400 million is nothing.
Yes, it's about to go buy side. This shit. Heavy buy side, 1.4 billion buy side. And
there it is. There it is. Fashionably late.
Jack, I don't know, man. What a day. Still sell side ES. There you go. We only got 5 minutes.
Wow, props to some big buyer. Fifth profitable day in the XFA and locking out. Nice job.
I mean, doing some math. What are we at? Like near 26,000.
Mm-hmm.
Okay.
Do something.
So like
pulling teeth.
$1 billion is only like 2,000 NQ contracts.
Can't not go lower. All right,
kind of muted.
Yeah,
I have to be careful. I have to be careful here that I don't accidentally get assigned on something if we really dump here. So I got to be like a cat.
Lock in, Jack. Dre, I got this.
Yep. What do you look at? 1.3.
I mean, honestly, only 50 points off the high. That's not as much as I thought it'd be. I mean, if it was going to reject, I would expect much more, like 60 to 100. I feel like it's holding up pretty well.
How many? 400 million? Like 400 million divided by 20. What's the NQ at?
1.3 bill. Buy.
Oh, what's the price in the NQ?
25 820s, let's say.
775 NQ contracts would give you a nominal exposure of 400 million.
Does that mean we're going lower?
Who knows?
I don't know. Don't forget we got Oracle. Right? Yeah, absolutely. I know. I love asking Jack the dumb questions. We got Oracle earnings coming up after the bell. Let's see what happens here into the close. ES trying to sell off now. 68.97 last trade there. NQ.
Are we gonna hit this above below in the ES? Those 69.12s. Chat said bearish on that. Let's see how that plays out.
What a weird 30 minutes. What a weird week.
Yeah. I mean, the ranges are well respected. Definitely expected more action though.
Yeah. Let's take a look around here. What a unconvincing sell-off. Into the close. We have 2 minutes. 2 minutes till the close. 2 minutes till the close. We're looking at about 15 points off the lows in, the highs in the ES, trading 68.97. Take a look at the NQ, about 60 points off the highs there. Trading 10s. We're going to buy this. Sell side growing ES. I don't know. Well, I am
Now
turning
what, Ray?
over. 10-year
MOC
holding up around the highs. Yeah.
MOC is come and gone. FOMC has come and gone. Please stay
FOMC
on this
has come and
range.
gone. We got jobs next week. Yeah. I mean, wow. Okay. That's all she wrote. We'll see what happens here in the last 90 seconds. Last 90 seconds. Will they continue to hammer this thing? Start hammering this thing. What? Or never.
Maybe we get under 800s here? Can they push under 800s? Buyers come in at 800s?
Yeah.
5-minute crash. Wow. Chad is saying that thing is going to crash.
It's going to crash. We're going lower. All right. They're saying we're going lower. Here we go.
All right. Let's see.
60 seconds. Jack, will we get up to 69.12? Will we get up to 69.12?
No, that was my lid. That was my lid on it. We didn't.
Ceiling's the roof. 25,808 last trade in. There's
some accelerated, slightly accelerated. Maybe we just chill at 800s.
Yeah, pretty much.
45
man.
seconds left.
Okay, yeah. Well, again, Oracle earnings after the bell. Make sure you tune in at the buzzer. Also, remember, give the markets a little bit of a period to digest. We'll see what the markets really think tomorrow. This is certainly not done. You heard the Fed, you heard Powell saying, and in the remarks, and in the voting, still a lot of uncertainty. Need more data, but that data's stale. What do we do with that? Their employment, jobs, weakening, inflation is being sticky. Let's see how this goes. Look at all that size on the ES ladder. 68.90 last trade. NQ trading 25,796.
And about 800s.
All right. It was not a sign. We're good.
That's interesting.
All right.
Interesting
Great job.
close.
Yeah. It's more
Great
on the upside. Jack, fantastic stuff. Dolby time, as always, my power hour, partner in crime.
So good.
That being said, shout out to all the bellers. What a day today. Thanks for sticking with us through some of the tech issues. We're going to be back better than ever tomorrow. We ain't done. Oracle earnings coming up after this. Throw it to my main man, Dr. Val. James, great job back there. Take us out of here into At the Buzzer. Great job today.
You guys got it. Well, chat, we laughed, we cried, we restarted the stream 4 different times, but FOMC has come and gone, and we made it to the end of our stream today. But don't worry, if you're hankering for more trading action, At the Buzzer with Coach Jay is coming up right after this. And the best part is, you don't even need to do anything, because once this show ends, it'll automatically redirect to At the Buzzer with Coach Jay. So get up, stretch your legs, grab another drink from the fridge, and then be right back here at the buzzer. That's at 3:15, so get ready for that. Then later tonight, 7:30 p.m., Coach Dakota, if he's feeling better, he's going to be doing slow markets tonight. Be sure to be there. Markets open back up at 5 p.m., but slow markets kicks off at 7:30. It is the hottest trading show at night. Then, tomorrow morning, 1:30 a.m., London Open with Aaron Trades. 3:30 a.m., Euro Trade with Deanna. You caught Deanna on TopstepTV today, once in Fast Markets and once during group coaching. Now you can catch her during her own show, Euro Trade, at 3:30 a.m. for our friends across the pond. Then we're going to be right back here doing the whole shebang all over again. 7:15 a.m. We're going to look at the fallout of FOMC, see how the market reacts, see if anything happens tomorrow. You never know. As Hogue always says, anything can happen. So stick with TopstepTV and trade with the best. But for now, I'm James Harden. You're the chat. At the Buzzer's up next. Have a great rest of your night, guys. We'll see you tomorrow. This is TopstepTV, and as always, let's go.